Welcome to Primary Markets TV, your insight into newly issued securities across the fixed income and equity space. I'm Ruth Emery. Joining me today is Ben Lord, a bond fund manager at M&G, and we're going to be talking about inflation and the bond market. Ben, welcome to the show.
Good to be here. Thanks for having me.
So do you think the inflation numbers that we're seeing at the moment are transitory, or could we be entering a new regime?
I think there's an element of both. I think that the high inflation numbers that we're seeing, particularly in the US, and we're also starting to see in the UK, are transitory. There's base effects, there's supply bottlenecks, there's labour shortages, all of these things that we're sort of working through as we come out of an enforced lockdown. And those are resulting in higher prints. So north of 5% in the US, north of 3% in the UK. Those numbers, supported by base effects, are going to fall out. So I don't expect inflation numbers to continue to rise from these levels for the next year or two.
Okay.
But I also think the question really as to whether we're entering a new inflation regime is, where does inflation settle back at post these factors coming out of the numbers? And I think there is a good chance that the residual inflation numbers are higher than they were pre-pandemic post.
And how do you think that central banks will react over the rest of the year and into 2022?
Monetary policy works, I believe, and we have had a period of exceptional stimulus, both in monetary terms from central bankers and in fiscal policy terms from the political side. In my view, those things are generating this higher residual inflation that we're going to get in 2022, 23, 24. In terms of how central bankers are going to react, I think most important at the moment is the Fed. The leadership at the Fed clearly want to stay behind the curve and run the economy hot and try to escape the zero lower bound permanently. The dot plot that we got a month or so ago suggests that a lot of the other members are keener to move ahead more aggressively and faster with tapering and taking some of that stimulus out and ultimately preparing the market for rate hikes. 3 months ago, they weren't going to hike rates till 2024. And 6 weeks or so ago, we found out most of them are expecting 2 rate hikes in 2023. That tells me all I need to know. The Fed is nervous about inflation, thinks the economy is strong, and is starting to up the dialogue around how to withdraw some of that stimulus. The Bank of England ultimately is going to be driven by where the Fed is. And I think the Fed has moved hawkishly. I think the Fed will start tapering between the fourth quarter of 21 and the first quarter of 22. And at that point, I think the UK economy will also move in that same direction. We're going to start to see less gilts being bought every week. At the moment, we're seeing 3.4 billion of gilts being bought every week by the Bank of England. In the UK, actually, unlike the US, we started a 150 billion QE program in November of last year, and it's set just to run until the end of this year. So we already know that that taper is coming in the UK, barring something extreme and exogenous that forces them to extend it and announce another program. So I think central banks are eking towards a more hawkish standpoint now, and that's going to see some rates fall, probably higher rates, probably steeper curves, and ultimately push inflation expectations down. That's what a hawkish response does. So that's my expectation.
And so what is happening with inflation-linked bonds at the moment? Are there any key trends there?
In terms of issuance, downwards, so corporates aren't issuing inflation-linked bonds. It's much cheaper to issue nominally, especially if you think we are entering a higher inflation regime. And the DMO in the UK has actually been running down its annual proportion of issuance in index-linked bonds. And that continues year after year. I think that the DMO felt that they had too many inflation-linked bonds. And if we do see a pickup in inflation, that's going to end up being expensive to the DMO, to the taxpayer. So issuance is low and very low in corporates, and issuance of index-linked gilts is also falling to try to bring it down to better levels to be able to deal with higher inflation if it comes.
And real yields are negative on US Treasuries and also across the Eurozone. So where do you see value in the bond market?
We're in a world where we've got huge levels of government indebtedness, particularly post-COVID, but also post-GFC. That suggests that central bankers don't want to see nominal yields go too high. Once nominal yields go above potential growth, they're going to feel that there's a problem and that it may end up tightening the economy and increasing recession risks. So you can see quantitative easing continuing for many, many decades to come, given the level of indebtedness that's out there. So if you think that QE sort of locks in nominal yields at low levels, you've got to ask yourself then, what are inflation expectations? Well, if we're in a reflation, break-evens are rising. If nominal yields are supported, then actually real yields can keep going more negative. And actually, I think that's probably a policy that central bankers the world over are pretty keen to have in place for the long term. So actually, yeah, real yields are negative. It's not easy to get good returns, but real yields, if inflation does come back and is sustainable and is higher, may well do better than nominal bonds.
And finally, how can bond investors protect themselves if we do see higher inflation in the future?
If you're worried about inflation rising and therefore CPI rising, then it's worth owning some index-linked bonds because they reference those inflation baskets. And clearly all of us are going to have different sensitivities to that basket. Then I think we've got the negative real yield problem. So what can you add to those yields to try to improve that return? And one thing you might well do, even though spreads are quite tight, is look to take some credit risk over and above those real yields to try to reduce the negativity of those real yields and to do so in a sort of reasonably defensive manner.
That's been brilliant, Ben. Thank you so much for your time.
Thank you for having me.